All right. Well, good evening and welcome, investors. Good to see a bunch of new names and names that are less recognizable to us. We're thrilled that you're here with us for this session. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing and a volunteer for the Better Investing Mid-Michigan chapter. And I'm joined here by my dear colleague, Ken Kavula. Say hello, Ken.
Well, hello, everybody. I'm so happy to be with you. This is my passion, teaching people about investing, getting them started on the road. I'll tell you, when I began investing close to 35 years ago, I never would have dreamed that I could accumulate the resources that I've been able to accumulate. I owe so much of that to better investing and to the things that I've learned from people like Mark and like some of you in the audience. It's been a wild trip. It's been a fun trip, and most of all, it's been very rewarding for my wife and I to learn about how to make this happen and then put it into practice and see it actually work out for us.
Now, we are specially targeted at those of you that might have limited investing experience. And Ken, I didn't clear this story with you, but I'm going to go ahead and tell it anyhow. I can remember buying my first stock back in the sometime around 1990. The company happened to be Waste Management. I actually took the afternoon off from work to go home, and at the time we had an account with Schwab, and I learned about the ticker symbol. And by the way, my reason for buying it was I liked the grizzly bear that they had in their lobby. So I go home and it's like 3 o'clock in the afternoon, and you had to order over the phone back then. So I place my order. I hang up the phone and I'm watching the ticker on the television, and the price starts at 38, and then it's 37 and a half, 37 and a quarter, 36 and three quarters. I called my wife and I reminded her we'd taken out some prime rib or steaks that we were going to celebrate with that night. And so I hung up the phone and it went down to 36 and went down to 35 and a half. And I called her back and she told me, well, put the steaks back in the freezer and get out hot dogs for tonight for dinner. So I have been there. You start this experience of investing thinking that all stocks know when you buy and sell them, and there's a whole lot of mystery and fear that comes into this. I got to tell you, discovering the modern investment club movement made such a tremendous difference in taking a lot of that mystery and fear out of it. That's basically what we're talking about here tonight, along with the justification and just the force behind what is possible. There are no guarantees, but what is possible if you unleash this type of discipline that we're going to be talking about. Any highlights you want to cover before we get started, Ken?
Well,
Now that I
Mark, let's
snuck in
get
the
the
hot dog story.
disclaimer. Let's get the disclaimer stuff out of the way, and then
Okay.
let's get started with our slides. And you know that I'll have stories to tell as we move through the whole process here. This is an educational demonstration, folks. We will be talking about some real stocks in real time. We're not suggesting that you buy, sell, or hold any of the things we talk about. We believe that you're bright enough to understand investing eventually, and we believe that you should be making your own decisions after a lot of review of the material that's available and doing your own analysis of the company and drawing your own conclusions. We might actually own some of the stocks we're going to talk about tonight, and if we do own any of the stocks, we'll try to mention that. But I love the sentence that we have in our disclaimer that says, we are not the boss of you. We don't expect you to follow any of the things we talk about tonight and immediately go out and do something rash. Now's the time for you to ponder what we have to say, to think about what's going on. And if you decide to embark on this kind of wild journey of investing as a better investor, then we're suggesting that there is some discipline to be learned, and there's a way to begin to learn it without becoming embroiled in all of the detail that many times turns beginners away from the path to real good, solid growth investing. We hope you'll be satisfied. And again, anytime you have a question, it's a great time to raise your hand, and we'll try to see at that point what you have to say. And I do see that I have a hand in the air right now, but I'm not able to pick up who that is. Let me see if I can find it. Maybe the hand's been taken down, but that icon will allow you to raise a hand, and I'll get a signal on my machine. There it is. The signal is from Bill Thompson. And Bill, if you'll unmute yourself, you're muted on your end, but if you'll unmute, then you can speak directly to us.
While we're waiting for
Okay,
that,
the hand went down, so we'll
okay.
have that happen occasionally, and we call that an inadvertent hand, and no harm, no foul. So let's continue, Mark.
Okay, just wanted to reinforce if you want to copy the slides that we use here tonight, or if you have follow-up questions, our 2 email addresses are there at the bottom of the page. Okay. All right. We don't normally do this, but we just thought we'd give you a quick look at the 2 of us and our significantly better other halves. And we're not going to read these to you. It just gives you some background on who we are. The fact of the matter is that Ken and I have been doing this type of stuff since, well, I date back to the early 90s, and Ken, you're right in that range also, correct?
I started volunteering for Better Investing and teaching in 1995, so it's
There
been
you
a
go.
it's been a long time, but it's been wonderful.
And for those of you that are familiar with Buc-ee's, yes, that is my wife and I stopping by at Buc-ee's on our current trip to where we're staying right now. So
This has
this,
nothing to do with anything, Mark, but I'll let you know in front of our audience that we had a full-page article in our local newspaper about the Buc-ee's down in Pigeon Forge, Tennessee.
uh-huh.
So my wife cut the article out and very carefully folded it up and is waiting to give it to you the next time she sees you. So
Excellent. All right. And then one last disclosure, I am the founder and managing partner of Manifest Investing. What it basically is, the elevator speech is, I got to work with many of you all around the country, if not the world, in my days at Better Investing on the magazine staff, and also some of the performance work that we had done, and literally took that and attempted to take the lessons that we're going to be sharing with you tonight and put them at your fingertips. Again, Ken has branded this the grand experiment. That is George Nicholson's term for the modern investment club movement starting back in the 1940s. And I'm not going to read the slide, but we do think that keeping it simple is better. Occam from Occam's razor was right. We focus in on the return forecast, the projected returns from the stocks that we study and carefully steward and own. Quality matters. And we do absolutely believe that anyone can do this. So again, slide is just there. If you wonder what manifest investing is about, we're going to also talk about companies like Value Line and the new Standard & Poor's, other companies that do this type of stuff. Again, it's up to you to decide whether it makes sense to you. So with that, who is this guy Nicholson we're talking about? Take us away, Ken.
well, George Nicholson from Grand Rapids, Michigan, is a Michigan grad. I'm sure that he's very happy wherever he is today for the win over Alabama a couple days ago. But George, in the 40s, pulled together a group of young men, including the famous Tom O'Hara, and said, I will help you start an investment club, but you're going to need a few rules, and you're going to have to tell me that you're going to follow the rules. And if you do, then together we'll put an experiment together to see if we can actually make some money. He set some goals, he gave us some forms, and most importantly, he laid the groundwork for hundreds of thousands of people learning how to become their own stock analysts, learning how to become good, solid, sleep at night investors, and making themselves uh, able to listen to financial experts or to manage their finances themselves. We owe an awful lot to Mr. Nicholson, and his first basic idea was invest regularly. Don't try to time the market, it can't be done. Your money comes in, your money goes out, and you need to invest some of that money on a regular basis during good markets and bad, during times when the globe seems to be on fire, and during times when everybody seems to be happy with everything that's going on. This invest regularly can be 12 times a year, it can be once a month, it can be once a week, it can be 4 times a year, it can even be twice a year, but it should be on a regular schedule with no attempt to put your money in at an opportune moment. That smacks of market timing, and again, that can't be done. His second principle was to, if you give me a click, to buy high quality growth stocks. And we're going to try to develop a little bit of a model by what we mean by high quality. I think most of you have a gut instinct for what a high quality stock is to start with. And for me, it begins with some company that has a product or a service that somebody wants and that's able to sell that product and service at a profit, make some money, and then share that money with the people that own shares of the company. That's called capitalism. And the higher the growth, the more money net most of the time the company has to share. I'm distressed right now when we get people on television talking about growth stocks that don't make any money, that have no earnings of any kind. I think that if you're going to be a growth stock, you have to be able to sell something and you have to be able to make a profit by doing that. Vocabulary, vocabulary, vocabulary. We'll be dealing with a lot of that during this particular first session. Nicholson's third point was to be prudent, to shop patiently and diligently. And I think another word that he would put up there, if we had the time to deal with it, was to be methodical, to do it in a way that followed some simple rules and that didn't deviate so that you didn't miss opportunities. This patience and diligence, this patience and discipline is so important when you're a beginner especially, but it's important for all of you, even if you've been investing for 30 or 40 years. You need to be patient. You need to have discipline in your methods, and you need to diligently apply the rules and eventually learn when you can successfully I don't want to say break the rules, but kind of bend the rules just a little bit to help you decide where you're going to go with your money in the near future.
Yeah.
Sometimes we go on, Mark.
Well, I was just going to say, we talked this morning about how the year has started so far, and I'm going to go ahead and name names. Jim Cramer. I love Jim Cramer. It's good entertainment. Every once in a while, a good idea will come across. But Cramer started by basically telling America to get out there and sell, and sell, sell, sell. And again, I'm going to sugarcoat this and say that, again, if you're out there as a beginner, so much of what we see on TV or even in the news media, even magazines, is really targeted at short-term thinking, and doesn't mean they're necessarily wrong, but it's different than what we do. And I'll second the notion that Ken made. He was making reference to early stage or breakthrough companies and trying to get in there early. That is difficult. That is not for a beginning investor. But what the ideal investment and the really important thing to take away is a company that has a proven track record that you can see. We're going to cover that in great detail during these sessions, but you got to be able to see the track record and have confidence in the company. And that really is the secret sauce that we're going to be covering here with the Grand Experiment and the sessions that follow.
Well,
Anything else?
Nicholson called this collection of young men. It was all men at that point that he pulled together into an investment club, and he called it his grand experiment. And he said, we're going to be able to look at our experiment over the years, and we're going to be able to actually measure our success by how successful each one of you are in your investments as we put in a little bit of money on a regular basis, focus on high quality growth stocks, and then shop and diversify our portfolio on a regular basis. So let's see how successful this grand experiment was, Mark. Why
Well,
don't you
this,
tell us about Tom O'Hara since you knew him personally, Mark?
yeah, this one is really cool. This is really that moment to reinforce, turn the sound off when the talking heads are on, and find better companies at better prices, and do that all the time. Tom O'Hara, again, he was a member of this Mutual Club of Detroit, the origination of the Grand Experiment, and chairman of the association for more than 50 years. And something that I find, I mean, I sat and I watched this. I was a member of this investment club. It's just phenomenal to me that he invested every $20 every single month since 1948. And the spreadsheet uh, excerpts are shown right there in the middle of the page. You can see those $20 right down the middle every month since 1948. So he had put in. Now think about this. I mean, I'm sitting there, brand new to the organization, coming in from Chicago, sitting amongst these guys. First of all, I was scared to death, but I'm sitting there with these guys. There were 4 or 5 of them around the table that had over $1 million in their mutual club account, and this was their play money. Just amazing. And when you think about, he put in a sum total less than $20,000. It's actually $13,000. He had taken out at that point in time almost $500,000, and he still had $1 million in his investment club account. And that really, it was a rate of return of 13.2% versus the stock market at about 10% over that time frame. So again, he beat the market by approximately 3. But look at the power of starting early and doing it regularly over time. He also talked about other clubs. These two references here down the middle of the page, clubs that actually had done better. 42 years at 17%. Here's 24 years at 23%. By the way, that's a staggering achievement. And so I got to sit, right there and watch it. It's almost impossible for the average person to relate to only investing, $13,000 and having those type of numbers generated. So what a wild exposure to it. And I'm here to hold up my hand and say, hey, I've seen it. I've seen it. Any other thoughts on
Well,
that, sir?
well, I've seen it in clubs that I belong to, Mark. People generating 14, 15, 16% personal returns, clubs that are beating the market by 2, 3, 4, 5 or more percentage points, and doing it for long periods of time. You and I are demonstrating the method at our monthly roundtables. The Mid-Michigan chapter has been running a program called the Mid-Michigan Roundtable. We've been doing it now for almost 14 years, and our portfolio is beating the market over that 14-year period by almost 5 percentage points. It can be done, and it can be done by people that don't necessarily have a finance background.
Mm-hmm.
Our roundtable comes with a scientist, a lawyer slash preacher slash what else did Cy do besides be a lawyer and a preacher, Mark? I thought he had one more job too that I'm not recalling, but
He has
our,
a smidge of engineering in there too. So engineering, legal, and now he's a full blown Baptist preacher.
and
So
Mark's an engineer and I was a teacher by trade, but Putting our heads together, learning the discipline, we're able to put together a tracking portfolio that we're doing right in front of the whole world. And we're showing you that you can pick great stocks. And we're going to show you some examples from that roundtable as we move forward. Here's some looking at the grand experiment as viewed through the lens of a number of different portfolios. Here's returns from 2016 through 2020, and you can look at the different bar graphs and you can say to yourself, well, I'd like the one that's tallest, and that's the roundtable one for this particular demonstration. But all of these, whether you beat the market by 1% or whether you match the market even, you're doing as well or better than 90% of all mutual funds, of all professional money managers, and you're not paying large fees to make it all happen. If you're an index investor and you're going to match the market, there's absolutely nothing wrong with that. But I've always been a little bit of a try to lead from the front kind of guy. And if you tell me that all I can do is match somebody else, I would like to try to beat it. So right from the beginning, my wife and I decided that we liked this idea of trying to stay ahead of wherever the market was and whatever you were using to measure that market. Mark, tell us a little bit why Robin Williams is on this slide, would you?
Yeah, and this question actually came to us. Every once in a while, we'll do 20 questions or 12 questions at our program known as Bull Sessions, Tuesday afternoons at 2. And this actually came from an investment club and just wanted to talk about the type of returns, because we do keep track of all this stuff. And they basically were wondering, what is different about manifests? Every once in a while, we'll run into slight differences between a traditional stock study and manifest. And what Robin Williams has to do with is just an invitation to think a little bit differently about a few things that we have traditionally held without violating the core principles at all. And between that and that point number 2, Ken and I both really do strongly encourage an interest in discovering the best small companies you can. So here is a look at, one major distinct difference. And what you're looking at on the left-hand side is basically the approach, the framework of taking a look at a company. We're going to cover this in greater detail as we go forward, but you're going to hear from Ken. We like up, straight, and parallel. We like the sales or revenue line to do this, and the earnings to be basically parallel to that. And this is just kind of a thought experiment that we had done going a few years ago. 2 companies side by side, which one looks better? This one is more consistent over here. We like this one a whole lot better. At the time of this, and you can read it down here, it's literally the same company on the same day. The difference being we had embedded analyst estimates here in this time frame. So the reason that we think that is very important, and we embed them in our trend analysis, again, leaning on the work of the analyst consensus following these companies, is we just think it's important and it's very influential. And then, Ken, I'll leave it up to you to debate whether or not stock price follows earnings based on that chart.
Well, I know some of you are asking the question to yourself right now, well, what if these analysts are wrong? And I'm going to give you an answer that's not very satisfying at the moment. I'm going to tell you it doesn't matter if these analysts are right or wrong. It's human nature to follow a group of people that are telling you they're experts. And when the analyst community speaks in a voice that tells you something's going to happen, it's human nature for us to believe that probably they're correct. I want you to think back just a year and ask yourself, how many of the analysts were telling you that we were going to have a recession in 2023? I think most of you will remind yourself that that was being told 1,000 times an hour on the various financial television channels, and it was being told to anybody that wanted to listen. The recession was imminent, it was going to be deep, it was going to be painful, and we were going to rue the day that we didn't make major changes to our portfolio. Even if they were wrong, and they did happen to be wrong in that instance, the behaviors that they suggested urged people to do things that better investing investors probably would shy away from. There was indiscriminate selling going on, and we had a stock market for about 8 or 9 months up through the middle of October last year that was probably feeling the results of all the jawboning that had gone on from the analyst community. Well, the analyst community suddenly turned on a dime, and they become quite euphoric right now about something they call a soft landing, and about things being rosy going into the future, and how things are just going to be as good as you possibly can make them. I didn't believe them when they were so negative. I'm not sure I believe them when they're so positive, but you saw what it did to the stock market. You can't tell me that stock prices don't only follow earnings, although they do. Here's a chart of Pulte Homes earnings off on the right there, and you can see those earnings taking a plunge from the high in around 2006 right there. You can see the plunge moving. So stock prices do follow earnings, but stock prices also follow the analyst community. Please remind yourself that these people have 24 hours of news to fill, and they will fill it with anybody willing to speak for 2-minute sound blurbs. Ask yourself how many times you've heard directly opposite advice coming on one of the TV programs within a couple hours of each other having it being said on TV. There's all different opinions, but when those opinions coalesce around the big idea, no matter what it is, then the ball starts rolling, and we can stay out of trouble. We, as better investors, can stay out of trouble by remaining patient and by remaining disciplined.
Yeah, anytime I hear that kind of stuff, I just simply go looking for a better company at a better price. I mean, Josh Brown was fuming about, I can't already mention a year ago, they were talking about the sure recession that was coming. They were talking about interest rates dropping, by the way. They predicted yields would actually drop with the onset of a recession. And they also recommended quite heavily across the board to invest deeply in Chinese stocks. This is a year ago. You can go back and look at it. It was pretty much sung unanimously across the board. So let's go ahead and shift gears into
Hey,
what we think is a pretty powerful, uh, compelling reason to invest in individual companies. So we're
Mark,
going
we
to
have a good question. We have a good question in our audience.
okay.
We're being asked the question, what does better investing consider to be the market? And I'll take a stab at answering that question. The market is any measure that you'd like to use that measures more than a single stock. I know there are people out there in the real world that use the Dow Jones to measure the market. There are many people, including many of the analysts that you watch on television, that use the S&P 500 to make measurements. We usually compare what's going on in our portfolios to the Wilshire 5000. That's an index made up of 5,000 different stocks in the market, and that covers a nice big chunk of the market itself. But the market is anything that you want to use as a comparing, and those indexes for the market all vary slightly. In fact, you kind of thought about this slide before we even got to it. I'm going to let Mark fill in the blanks on this slide, and you'll see where we're talking about.
Yeah, I mean, the Wilshire 5000 over the long term is going to really resemble the S&P 500 because of the cap weighting. The companies at the top dominate. And what you're looking at here is a look all the way back, basically 30 years now, at the Wilshire 5000. And you can see that over that time frame, the return on the average stock here has been about 10%. Okay. These 7 stocks up at the top, they're not picked at random, and these are a little bit random on the timing, but just to illustrate long-term perspectives and different returns for the Wilshire 5000. That's what the benchmark is over that time frame. Anytime you want to compare the performance of anything, you have to be careful to either be using the same time frames or actually do the benchmark versus the Wilshire 5000 and determine the relative return. The relative return is the answer to the question, how much did that particular investment beat the market? And this is annualized over that time frame. So you can see Amazon since 1997 has generated a 33% return, beating the market by 24.5 points. Okay, so these 6 stocks, or actually 7 stocks, they're kind of our magnificent 7, not the ones you read about in the newspaper, but here's why they actually are that. At Manifest, we keep track of the favorite companies that are most widely followed by our subscribers, and you will see all 7 of these are up at the top. We're fairly certain that those companies are present in a large number of our portfolios in the community. I've got 4 of them. Ken, I think you can actually beat that.
I actually, in one portfolio or another, Mark, own all 7 of these.
Okay, so I mean, some of those are not the most stocks that you hear most frequently on Wall Street, like a Fastenal, even Visa. You're not hearing Visa every day out there, but a lot of people do track those. So again, it's not 7 stocks at random. It's the 7 most widely followed companies by subscribers. So again, keeping that in context. Here's a look at the indices down at the bottom. And again, there's, like Ken said earlier, nothing wrong if you want to be fairly passive or less involved in buying these type of investments. You can invest directly in the Nasdaq 100 or one of these other components, the S&P 500. And for a source for a beginning investor out there to understand some of the ins and outs, I would recommend the work of John Bogle, Common Sense on Mutual Funds, so you understand the lay of the land. There's some things you want to understand and become familiar with exchange traded funds versus traditional mutual funds. Make sure you go out there and do that homework. But it's okay to invest in these, especially in 401k programs and that kind of stuff. But the numbers down here are going to be a lot less flashy than the ones at the top. Again, it's these type of companies that we think we find these type of companies using our approach that empower the better performance. Ken already mentioned this one. The investing roundtable checks in at about 16% since 2010, so it places it right there in the middle of the chart. And we've just had a whale of a good time. If there's any one thing that I can bring based on my experience with the Mutual Club of Detroit, Ken's been in 19 different investment clubs, I think, over the years. It really is a whole lot more fun, and in most cases, potentially a lot more effective investing with your friends. So this is a pretty powerful slide, and the best small companies that we talk about a lot around here are also here as part of this demonstration. Anything
Mark,
you want
why
to add
don't
to
you
this?
explain explain, Mark, what the Tin Cup demonstration portfolio is, would you?
Okay, the 10 cup demonstration portfolio we do at Manifest Investing. It's basically taking the maximum amount that you could put into a 401k program ever since 1994. And the approach is really exotic. You literally are just looking for the best companies available at the best price, month in and month out. It's no different. We tell the stories of back in the old days. Those old days are actually not that long ago when we used to actually sit with the paper version of Value Line and licking our fingers and turning the page and trying to find an interesting company to study and perhaps own. This is inspired by the work of Warren Buffett, the work of Walter Schloss. If you're a brand new investor, you might want to write down that name, Walter Schloss, Schloss. And literally all he did was take the value line, look for a better company at a better price. That's what the Tin Cup portfolio has done over a period of almost 30 years, generating this 16% return. And it's really a very simple method, and it's been quite effective. Okay, anything else we want to add here, Ken, other than just noticing these numbers? That's why we put the wow lady on the slide. All right, here's a look at that Tin Cup over time. Again, going page by page, of course, using computers now, but looking for a better company at a better price. And it's a bit of a bumpy road from time to time. You can see how the total assets in the Tin Cup, this demonstration portfolio, compared to the Wilshire 5000 down below. And we really believe this is an example of a fund that stays basically fully invested at all times and with no attempt to time the market at all. And back here, one of the things we like to point out in many of our weekly programs, this period in the stock market that you can actually barely see right now. I mean, squint a little bit and look at that little drop right there. That was the worst thing to happen in the stock market in history back at the time when it happened in 2008, 2009. And I just find it staggering that you can barely see it on a chart like this. Your thoughts, Ken?
Well, nothing except we thought we were geniuses back in 2021 when the market was just taking us so far above that trend line. That blue line is nothing more than a computed generated trend line of what the expectations, what are reasonable expectations for market growth. I think it's set at around what, 10 or 11% mark. Is that right?
Probably right around there.
Yep. Yeah, and we really like it when the portfolio moves above the blue line, and when it moves below the blue line, that means it's time for a little bit of thought about what you need to do to increase the potential in your portfolio. That's called portfolio management, and that's a class for another day.
And again, I want to reinforce down at the bottom, we'll read it together. It's not a complicated strategy. First, you find, you identify, you discover an excellent company. Even better if you share it with your friends here in this community. Number two, you are patient. You buy it if and only if it's on sale. And Ken's going to talk in great detail about that in the next session. And three, you hold it for as long as it makes sense to do so. And in many cases, that's going to be for a very long time. We have compared notes on this in the past. I still have stocks that we bought in the early 1990s in our personal portfolio. And some people out there in the market find that hard to believe. So hold it for as long as it makes sense to do so. All right, so there's your look at the whole thing. The one other thing we want to point out is we do sometimes look at the performance of the value line arithmetic average. We consider that to be an important barometer. We call it all of the above investing, and the reason we do that is it's equally weighted. It's not like the Wilshire 5000, so no one company dominates, and it is chock full of medium and small companies. So you have this blend of large companies, medium-sized companies, and smaller, faster-growing companies.
Notice that average only beats the market by 1%, and that doesn't seem like very much until you identify the concept of compounding, and you begin to realize when you look at the compounded values that a 1% difference in your compounding percentage can make the difference in literally hundreds of thousands of dollars in your nest egg over a 40 or 45 year period. So don't despair if all you're doing is beating the market by a percent or two. Again, you're doing as well as 90% of the exchange traded funds and mutual funds that exist, and you're able to add to your nest egg and make your life a little bit more comfortable as you move into retirement and maybe even early retirement.
Okay. All right. Every year, Ken and I do a program of picking out the best small companies on Halloween. So, Ken, I'll let you describe how well we did for 7 years, and then if you want me to, I'll be the one to eat the humble pie for the last couple of years.
Well, for 12 or 14 years prior to 2015, we were looking at the Forbes lists. Forbes used to put out a list called the best small companies, and we thought it was chock full of great ideas for investing, and we followed it. We made charts of it, we made spreadsheets using it, and we communicated the best ideas from that list to as many people as would listen to us. And then in 2014, Forbes decided they were not going to publish that list anymore. And we thought that was a shame. So we decided in 2015 that we'd come up with our own best small companies list. We weren't going to put in the work to do 200 companies or even 100 companies like the Forbes list had contained, but we thought we could put together a list of 15 or 20 companies, and we would label them our best small companies, and we would see how they did compared to the Wilshire 5000. You can see that in 2015 through 2021, our lists beat the market every single year for 7 straight years. And then we hit 2022, which everybody will admit was kind of a strange year in investing. These years start on November 1st and go to the next November 1st because Forbes used to put its list out the day after Halloween, and that is November 1st. So in 2022, actually, 2021 November to 2022 November 1, we did not beat, for the first time, we did not beat the market. Both the market and our list lost money. And in 2023, again, November to November, the market actually made some money and we lost again on our list. Small caps from the pandemic onward had been in a real slump, and we were measuring that slump by looking at a set of companies that for the most part were not keeping up. Starting in October of last year, small caps have suddenly been revitalized and they are doing wonderfully right now. I don't want to say too many good things for fear of jinxing the
He thinks we
performance
jinx
this
ourselves,
year.
yeah.
I do think we publish it too often and jinx ourselves, but for the last couple of months at least, for the month of November and December, our list is beating the market handily, and we hope to go back to the graphs that look like they did in the earlier time. What's important is that a portfolio should always be looking for great small companies, because if you put great small companies into your portfolio, your goal is that those great small companies will grow into great medium-sized and then great large companies. And eventually, you're still going to need some great small ones to take up that slack. Why? Because great small companies tend to grow at a faster rate, and because earnings follow sales and stock price follows earnings, if they grow at a faster rate, they tend to have stock prices that grow at the same faster rate. Overall, our best small companies have returned 13% annualized, and that's versus a 10.1% annualized return for the Wilshire 5000 over the same time period. We'll keep you updated on the best small companies, but this is an important thing for you folks to internalize. You need small companies in your portfolio.
And I sat in the Mutual Investment Club meetings and I would hear the stories of George Nicholson. I didn't get to see it in person, but George would walk into the meetings for years, every single month, walk through the door and say, "What small company are we looking at tonight?" And we're going to look at O'Reilly here in a few minutes. They bought that company back around 1970 and still had it after the year 2000. So great stuff. All right, here's just one quick other reminder. Um, this is just a personal moment that I thought I would share. Again, if you're out there in the audience and you're looking to engage this and explore, there is so much that you can, so many doors you can kick open. Younger is better. Start as early as possible. And this actually takes on a notion. I mean, it was really cool. I was actually at one of the investor conferences. This one happened to be in Springfield, Illinois, and my parents attended this conference. And they were sitting at breakfast with the investor relations person from Biomet. And the Biomet representative told my mom and dad that $2,000 invested in Biomet back in 1982 was worth nearly $1 million in the late 1990s. And my dad sat there and said, "You know what? I had the IRA back in 1982. I was looking for a home for $2,000. Wouldn't that have been cool?" And the reason we bring that up is Biomed is not the sexiest, flashiest company out there. They were acquired by a Zimmer ultimately, but it's a medical device company, joint replacements. And the point is, because you hear this almost every day, the next Amazon, the next, well, now it's NVIDIA. You don't always need the next Microsoft to access this opportunity. And this is taken from a letter to my grandson that was born back a few years ago. And hopefully it's something that they'll take to heart. And Ken, do you want to take this one away? I already mentioned them. I mean, this is just phenomenal that O'Reilly was purchased by the Mutual Club back in the early 1970s.
Well, I happen to own shares of O'Reilly that we purchased in 1997. So I'm a participant in this kind of phenomenal growth with a company that a lot of folks probably are familiar with the name because they see the stores all over the place, but they're not really familiar with the fact that you can own stock in this company. I'm in clubs that own O'Reilly today, and we're very, very pleased with it. I will make the observation that O'Reilly stock has been discovered by many, many people, and it hardly ever falls into the buy zone on a good, well-prepared analysis. But when it does, it might be the kind of stock that everybody should seriously consider including in the portfolios that they're managing. Notice that the relative return for O'Reilly is plus 11%. That does not mean that O'Reilly returned 11% per year. What it means is that O'Reilly beat the market by 11.6% every year. It actually returned 22% per year from 1994 to the end of this chart, which is in the middle of 2022, I think the chart goes up to. It's a revolutionary idea, folks, that a single stock can, with some patience, some discipline, and some prudent stock investigation, yield these kinds of results over basically a 30-year period.
All right. And kind of closing up with a slide which I think is just staggering. Many of you in the audience have seen this. We update this from time to time. Again, the roundtable has met since July 2010, and the rate of return that has been achieved is this 16% number. Okay, so what we do at the roundtable is anytime one of us selects it, whether it's a knight or a damsel or the audience, we put $1,000 into that and then we track it. So at this point in time, we basically took a look at which companies had current values or closed out position values less than 1,000, and we discovered that 220 of the 780 selections, in other words, about a fourth of them, actually were down below 1,000. Now, a lot of those are, 990, 985, nothing to write home about, but some of them are much bigger drops than that. In fact, I think we have one that went down to $40. $1,000 going to $40. I got to tell you, even if it's fake money, pretend money, it's painful. So
Especially if you chose the stock,
yeah, my name is right there in big bold letters. So anyhow, you add all these up, the unrealized and the realized losses, you get this number, 64,000 on up here. So $64,900. And then we notice that Microsoft, it's the largest position in the portfolio, has only been selected 5 times. So $5,000 has grown to become this. And I'm telling you, I get chills every time I think about this because the gains from that company, Microsoft, stand at about $90,000. It absolutely absorbs and offsets all of these up here. And I don't know, maybe I'm not looking at this right, but every time I look at this slide, I can hear, I literally can almost hear the voice. What are we afraid of? Because I mean, we're talking about, 780 different decisions. Anytime you make a decision, if you know that this power and this potential is out there, again, no guarantees in the realm of investing, but this is what is possible. So I don't know. I see it as knowing that this is out there and possible, what are we afraid of? Your thoughts, sir?
Well, in the bull sessions, Mark, you and I and some of our friends have been investigating investor psychology with some really great books that we've been reading and are reporting on to our audiences. And one of the things we've discovered about investor psychology is that investors tend to focus on their losses. They tend to want to make their losses right. They tend to want to do things that are probably kind of foolish when it comes to losing positions. In fact, what they should be doing is focusing on the 5 or 6 winners they have, understanding that a loss can only lose as much money as you invested, while a winner can have an unlimited upside to it. Microsoft, $5,000 in, $95,000 out, and no end in sight at the moment. Meanwhile, some of our other stocks that shall remain nameless, $1,000 in, 500 out, and gone forever. If you focus on your winners, and if you end up with, over a period of time, only 3 or 4 or 5 home runs, that's all you need to balance out the entire sum total of your losses if you're being patient and if you're being disciplined in your approach to investing. Now, this portfolio has many, many, many more stocks in it than you would put in a regular portfolio. This is a tracking portfolio that keeps track of all of our ideas over almost 14 years. But the process and the ideas of putting this portfolio together are all the same. We close out positions. When you hear that better investing members are buy and hold forever, maybe buy and forget investors, that's absolutely untrue. We buy and hold for as long as it makes sense to do so. And when do we sell? When we can make the portfolio better. If I can keep Microsoft moving in a direction and hold it in my portfolio for as long as it's moving in that positive direction, then it's going to help me balance out everything else that was done in haste and regretted at our leisure in all of our 228 losing positions. This, you're right, Mark. The slide is chilling in its simplicity.
Here's another another one that came across the transom just in the last few days. It's a busy slide. I apologize for that, but it literally is a reminder to invest regularly and do not be afraid. In fact, what you're looking at here, don't worry about all the words. The blue stuff is the times and magnitude when the stock market goes up. The stuff down here that's a little more orangish or reddish are when it goes down, and by how much. How much does the blue overpower the red or the orange? It's a huge difference, and we spend a lot of time worrying about this. Again, a person in our community kind of ignores this, knowing that this blue stuff is true, and gets out there and buys better companies at better prices. And for those of you that are relatively new to this, here's one for you, an absolute. Stock prices fluctuate. They just do. If you were here during our green room session, you heard that some of the stocks we picked yesterday went down 5% this morning. To many of us, that's simply good news because it gives us an opportunity to accumulate more at that lower price, so long as everything's okay with the company. But stock prices are going to fluctuate. They fluctuate up, they fluctuate down. And we're going to go into this in much greater detail in the next two sessions. But again, just reinforcement of what these things look like. And again, at any time, independent of what the market's doing or what the talking heads are saying on the TV, pick a good stock, wait for it to be on sale. Buy excellent companies. And Ken, I think we're basically at the point, just some quick reminders about how to take the emotions out. We're going to cover some of this stuff in future sessions, but I think we're pretty much at our transition to the next session. Anything you'd like to add here as we close out this segment?
I think we're coming awfully close to the time we indicated that we were going to wind up this particular webinar. Mark, could you give folks just a chance to read a couple of those things from the slide before this?
Go ahead. What's your favorite?
Well, my favorite, I think, is Peter Lynch saying, know what you own and why you own it. I think it's awfully important to be able to explain what every single stock you own, to explain what it does in language that I'll use a fifth grader as a good example. If I can explain to a fifth grader what every single one of my stocks does and why I think I should own it, then I think I'm in pretty good shape with my portfolio. I think Peter Lynch, one of the most famous investors in history, was right on the money when he explained that people should be buying what they know and they should know what they're buying. It's just so important for us to focus on that concept as we begin to move into buying individual stocks and placing them into a portfolio. And again, we go back to a few words: patience, diligence, discipline. These three words, I think, are the epitome of what a better investor should be.
Okay, and we are going to cover the growth and the profitability in greater detail in the next session, but this is the type of stuff you want to take a look at. So again, we will be reconvening at 8 o'clock Eastern Time. These sessions will be posted on YouTube in 3 separate segments. And our next section is going to be about how do we decide when you've got a better company and whether it's at a better price. So making reasonable forecasts is the subject of our next session. So with that, Ken, I think we can go ahead and shut down, field some questions.
Well, I am going to answer one question, Mark, on the broadcast itself, okay?
Mm-hmm.
We've had a couple people ask us, what's a great number to use as a buy range for O'Reilly? Folks, that smacks of somebody trying to jump onto a talking head and make a buy based on somebody else's opinion. We would like you as an investor to be able eventually to come up with your own great buy price for O'Reilly, because the price that O'Reilly might be appealing to you is probably a slightly different price than the price that it might be appealing to me. Age makes a difference. Whether you're very conservative or very aggressive in your investing style makes a difference. What your own family situation is makes a difference. And I would think that we hope that we'll get to the point where you can all evaluate almost any stock you pick and choose. We used O'Reilly as an example of a stock that was a home run. And again, you don't have to hit more than 4 or 5 home runs in an entire investing career in order to be a successful investor.
Okay, and maybe we can take a closer look during the intermission at O'Reilly. We're not afraid to do that.
Sounds good.
All right.
Sounds good.
Thanks, everybody.
We'll be on chatting on the next webinar at about 7:30 Eastern time. If you'd like to come early, we will be chatting and we'll be answering a lot of questions. And we'll stay right now, but we are going to turn the broadcast off. Our second broadcast will begin at 8 o'clock Eastern time.